The stock market's at all-time highs. What should you do? The stock market, S&P 500, is hitting record highs again. And if you're dollar cost averaging into the index funds, your plan is probably telling you just keep on buying. But here's where many investors feel uneasy. By several long-term measures, the market is trading at well above historical norms. Add in tariffs, add in high levels of debt. The fact is, there's always reasons not to buy and not follow the plan. The fact does mean expectations are extremely high for the stock market to continue. So the real question is the market expensive? And how should you behave? Because it is expensive. So let's break it down calmly, rationally, using historical data and just common sense. What the valuations are really telling us today. One of the widely followed valuation metrics compares prices to long-term earnings. It's a fact. Historically, that number averages around the mid-teens. Today, it's more than double that. A lot to think about. In the past, we've seen similar conditions before. It doesn't mean they're going to be the same. The late 1990s tech bubble, the run-up before 2020 and 2021 correction, you can say 2007. Each time, markets eventually pull back, but not overnight, not painfully, like immediately parallel, like implosion, but painfully enough to shake confidence. So what does it mean? Does it mean sell everything? Try to guess the top? No. It means future earnings and returns are likely to be lower and more volatile than what investors have really gotten used to. So the other really fact that no one really talks about is concentration risk. And it's the market concentration where you have a very small group of these massive technology companies now represent a very large portion of the index. And you know who they are: Microsoft, Nvidia, Google, you know who they are. Much of the recent performance of these particular stocks have to have near perfect results for this bull market to continue. And they can, but it doesn't decrease the risk. There's an inherent risk. So when optimism is extreme and expectations are stretched, and even a small little disappointment can have outside effects. So I'm going to ask you again, should you stop buying? And this is where most people get it wrong. They try to guess the top and the bottom. It doesn't work. Legendary investors don't know to pick the tops or the bottoms consistently. So this is the part that most investors forget, really. Dollar cost averaging adjusts for high prices as well as for low prices. When prices are high, your allocation buys you fewer shares of the ETF. When prices fall, the same amount of money buys you more shares. You don't need to predict anything. The math does it all for you. And this really is very simple math. That's why long-term automated investing has worked through every major crisis in history. Okay. When this strategy works and when it doesn't work, because everything is a personal decision of our own, not me giving you advice. Dollar cost averaging works best if you have a long runway. You have 10, 15 years or more. Your investments are diversified. You can emotionally handle downturns of 20, 30%. And yes, 50% drawdowns. They will happen. I promise you. So if you're close to retirement or very heavily concentrated, or you're not comfortable with the volatility, you might need to think about some other things and take a more balanced approach, not panic, just plan. That might mean more bonds or more just interest rate ideas. So you personally need to review your asset allocation, understand your own psyche of how much risk you can really tolerate, making sure your strategy matches your long-term timeline. And really, the big takeaway is, yeah, the stock market is very, very expensive. But guess what? It can keep getting more expensive. But conversely, the returns might get lower. It might be a bear market, and there might be massive volatility. But history shows disciplined investors who stay consistent, don't abandon their plan, are the ones who come out ahead and are financially secure down the road. This is a long-term game. The real danger isn't buying at all-time highs. It's changing your strategy emotionally when things become uncomfortable. And I promise you, they will become uncomfortable. So have a plan, automate it, review it, and let time work for you. Let compounding work for you. And if you found this helpful, share it with someone who's wondering really what to do, because it took a long time to learn all this. I want to thank you for watching and stay rational out there. And watch more of my videos to learn more. Thanks.